Um, like Tabby said, my name is Jeremy Forsyth. I own Forsyth CPA. Kedron is my colleague here. We are the main two who kind of run this firm. We do a lot of stuff that we'll get into a little bit later, but today we are going to talk about reducing your tax liability, saving money, keeping your money in your pocket. Every year, for the most part, one of your biggest expenses at the end of the year or in any given year is going to be your taxes. It's not going to be your rent. It's not going to be your vehicle. It's going to be your taxes. And so that's something that we can try to control and try to reduce that liability. And so with that, we will go ahead and get started.
Woohoo.
So as I said, I'm Jeremy Forsyth. I have moved around, just a quick introduction. I moved around a lot growing up, kind of settled in Nashville when I was in 8th grade, moved around a little bit after that. Started my career in audit, worked some in audit, worked some in tax, and then finally decided to kind of start my own thing and jump into the CPA world and try to help out some small businesses. We've noticed there's a pretty big need out there for small business accounting and tax, and so we try to fill that niche. And so I'm going to let Kedron introduce himself too.
Yeah, so I'm Kedron Hilario. I was actually born and raised in Los Angeles, California, and I moved to Nashville in 2005. So at that time, it was a complete culture shock. Here I am, this city boy, moving into this more of a rural side of town. But there, I went to Laverne High School, then I moved on to MTSU, where I got my bachelor's degree in accounting. I also stayed there for my master's degree while working at our largest healthcare company, actually domestically, and achieved my CPA license there as well. I have 4 kids, so we're looking at if anything's possible, having 4 kids, doing tax work, doing accounting work, anything's possible. And they range from ages 1 to 13. So there's some large gaps there. I also love to coach football. I love to coach youth football. Do a little bit of sports myself. So not just your average, typical, boring introvert accounting where we're just crunching numbers, but we love to do that as well.
I love it. John Griffith could relate to you, Kendron, about the 4 kids there. Right, and running a successful business and doing all the coaching. He's got the 3, and very similar story. So
nice. Yeah, so it just keeps us busy, keeps us on our feet.
Yeah, no downtime. Kedron, I'll go ahead and let you take this one.
Yeah, so today we're going to cover, of course, the largest tax savings are our credits and deductions. We'll also look at the payment protection program. So although it's not directly related to taxes, we wanted to give you guys a couple insights on the requirements, the uses and considerations as real estate agents, because you are your own business. Jeremy will cover some tax strategies. So one of my favorite tax strategies falls under the Tax Cuts and Jobs Act. I actually learned it from Jeremy, and I'm now saving a bunch of money because of it. And then we'll just take a quick look at some of the CPA services that we provide. We also listed out a bunch of frequently asked questions that we get, actually just a few, but then we want to open it up at the end and wrap up with questioning, answering directly from your staff.
So kind of as real estate agents, the toughest things you guys have, there's a lot of give and take for being your own boss. You're your own boss. You have the freedom to work from your own schedule, unlimited income capacity, but at the same time, depending on how you're structured, there's a lot of taxes involved, whether that's state taxes being franchise and excise taxes, business taxes, you have having to file your annual report. As real estate agents, you don't have this, but a lot of our clients have sales and use tax that they have to pay. As we put here, you're going to be the one who's having to calculate your own federal tax and payroll tax withholdings, because brokerages don't withhold that from your commission check. And then, it's just the record keeping, your mileage, your meals and entertainment, your agency fees, your splits with your commissions or to, Keller Williams. So all these things, your insurance, all this stuff goes into it. And really, as a sole proprietor, a lot of people, myself included, you go into an industry because you say, hey, I know how to do this. Great, I can do this. I know how to make money doing this. But what you don't realize is there's a whole lot more that goes into being a sole proprietor or an LLC or whatever you are than just the actual act of earning that money. There's a lot more stuff on the back end and stuff that can actually help you out a lot as it pertains to taxes.
Yeah, and as I heard online on one of the, I guess it was GIFs or memes or whatever they're called, ain't nobody got time for that. All the
That's
record
right.
keeping, all the petty tasks. You just want to focus on your clients, your colleagues, your networking and relationships. All the extra paperwork, you could probably do away with doing that.
Yeah, absolutely.
But it's needed. It's much needed.
Definitely a requirement. So the first thing that we are going to go over today are tax credits. And so before I jump into this, a lot of people don't know this. Maybe the people who are watching today do, maybe they don't. I don't know. The difference between a tax credit and a tax deduction. You'll hear those two things thrown around a lot. A tax credit is dollar for dollar off of your tax bill. So at the end, when you get done filing your taxes and it says you owe $1,800, but then you miss a $600 tax credit, it's going to take that $1,800 down to $1,200. If you missed a $2,000 tax deduction, that just takes away what your tax liability, your taxable income. That's going to lower your taxable income. So the amount that's subjected to taxation is lowered via a tax deduction. Your actual tax bill is lowered via a tax credit. Tax credits can be refundable or non-refundable. So tax credits that are refundable, it doesn't matter, how much you owe or not, either the full amount or a portion of the amount of that amount can be refunded to you. Non-refundable tax credits, they will only eliminate the amount that you owe, but then it will not refund to you if the tax credit is more than what you owe at the end of the year. The first thing we're going to go over is the recovery rebate tax credit. This is part of the CARES Act, and it is it's directly related to the stimulus checks. So some people didn't get the stimulus checks, whether they didn't file their 2018 or 2019 returns. That could be a reason why, or maybe they didn't get the full amount because they had a child. We had a child this year, and so we're getting a credit at the end of this year because our 2019 taxes obviously did not include that child on there because he was born this year. And so because of that, we're getting an extra $500 from the first EIP or the stimulus check, and then another $600 from the second one because we didn't catch that on the front end. So one thing that I will say about this is that there are phase outs with this. I think it's $75,000 for individual filers, $1,500 or $150,000 for joint filers. Excuse me. What I'll tell you about that is that the actual rebate credit is going to be based on your 2020 numbers. So if you made, if you were married filing jointly and you made $120,000 in 2019, but then this year you made $180,000, well, then you're not going to get that credit because your 2020 filing status will phase you out. Even though you should have gotten it because of your 2019 numbers, the actual the recovery rebate credit is based on your 2020 AGI. So hopefully that makes sense.
And we got another one coming, another EIP or stimulus check.
Yep, that's right. With the $1,400, I believe, is what that one is. I can't remember what it is for children.
It's the same.
It's $1,400 for each.
Yep.
Kedron's about to go on vacation. That's why he has 4 kids right there, just for these stimulus checks.
Exactly. I just look at them and see dollar signs.
That's right. The next that we're going to go over is a child tax credit, and you may have heard of this. It's for individuals who claim a child as a dependent. They have to meet certain conditions. the credit is for 2020. The credit's for $2,000 for anybody under the age of 17. Now, this, like the new American Rescue Plan Act that Kedron was just referring to, is going to, I say replaced in this slide, but it's actually kind of amending it in a way. So this credit begins to phase out when the AGI hits 200,000 for individual filers, 400,000 for joint filers. But again, it's $2,000 per child under the age of 17. If it's over the age of 16, so 17 and 18, or through college, there's a different deduction you can get, which is an other dependent tax credit that you can get. I said deduction, I meant credit. Bad on me. 2021. So this is going to be where you're going to be able to see a little bit more money for your kids. We actually have a client. He called me the other day, and I was like, dude, I'm so sorry, because he has a kid who's 17 this year, and so he got the other dependent credit. And then he was like, well, am I going to be able to get the child tax credit now that they're extending it to 17? And I was like, nope, that's for next year when your kid's going to be 18, and they're bumping it up to $3,000. So he misses out on it kind of twice, which is a big bummer. But the American Rescue Plan Act, it's going to see a big increase for your child tax credit. It's going to go up for children under the age of 6, so 0 to 5. It's going to be $3,600 per child, and then for children from the age of 6 to 17, so they're extending that from 16 to 17, the cap age will be $3,000. It's fully refundable. The previous credit was only partially refundable. I think you could only get $1,400 per child as a refundable tax credit for the child tax credit in 2020. They did, however, lower the phase out. So where it was $200, $400, now it's $75, $150. And at every $1,000 increment, the credit will go down by $50. So I believe it phases out at like $180 for a $3,000 child, and whatever that would be, maybe another 12 years, or another 12,000, so $192 for a $3,600 child. They are going to allow you to have an advance on half of the 2021 credit due to the COVID and everything. And so you can qualify for that to get an advance on this credit beginning in July and running through December. And then the remainder of the credit will be issued at the end of the tax year. The dependent care credit, which is something that a lot of people qualify for, basically this is when you have kids who are in daycare. The total expenses used to calculate the credit can't be more than $3,000 for one kid or $6,000 for 2 or more. So Kedron kind of gets hosed on this one, because even though he has 4 kids, if they were all in daycare, he would only get a $6,000 total expense cap. The tax credit is worth between 20 and 35% of your qualified expenses, depending on your AGI. So AGI of less than 15% $15K can claim 35%, which is for a $3,000 credit would be around $1,000. And then that percentage decreases until your AGI reaches 43, so it kind of phases out. But then at that point, it kind of levels out at 20%, and that's how much your credit is. So for one child, $600 for 2 children or more, $1,200 in the dependent care tax credit. The earned income credit, it's a refundable credit, fully refundable. Well, I believe tax credit for certain people who have earned income under $56,844. I literally just took a snapshot because there's so many different. It's kind of like filling out your I-9, where it's like I need 1 from this column, and then 2 from this column, and then 1 from this column to try to figure out whether I need a passport or a bank card or whatever. So we're going to leave this up here, and we're recording this so you guys can see this. But there's just a lot of different rules in terms of what you qualify for, and depending on how many dependents you have, and you have to qualify for everything under Chapter 1, and then either 1 of Chapter 2 or 1 of Chapter 3, and then also here's Chapter 4 for the other qualifications. But basically, what it is you get a tax credit if you have a certain amount of dependents and you make a certain amount of money.
Jeremy, I'm probably not the only one with this question. Could you just briefly explain the difference between the refundable and non-refundable credits?
Yeah, sure. So a refundable tax credit means that even after so if you had a tax liability, let's say at the end of the year, you got your tax bill and it was $700 that you owed, and you missed, or your CPA missed a $2,000 credit that you should have gotten. If it's refundable, you'll get $1,300 back because it is a refundable tax credit. If it's non-refundable, it will just eliminate your tax liability to zero, but then you won't get a refund due to that tax credit. The American Opportunity and Lifetime Learning Credit, this is a great one for both parents and people who are still kind of in school. There's two credits available, the American Opportunity Credit, the Lifetime Learning Credit. American Opportunity Credit gives up to $2,500 per eligible student for qualified higher education expenses. So you're looking at tuition, materials, costs of applications, things like that. It's 40% refundable, so you get up to $1,000 refundable, and it's only available for 4 years. Now, if you have a child who's in college, you have to choose one or the other. You can't take both of these. The American Opportunity Tax Credit, again, is it's subjected, to phase outs. Let's see. So yeah, between 80 and 90 for single, 160 and 180 if you file jointly. So it starts at 80 for if you're single, and then it's completely phased out at 90. And then for married, the phase out begins at 160 and ends at 180. Are you guys familiar with phase outs? I mean, do you guys understand kind of what that means when I say that a tax credit's getting phased out? Yes, no, no. Okay, so when I say that a tax credit's getting phased out, it means that until your income, for example here, until your income reaches $80,000, you get the full tax credit. And then beyond that, the tax credit's going to reduce until your income reaches $90,000. So whatever it is, I guess for this one, it would be about $250. It'll go down per $1,000 until you get to 90,000. So if your AGI is at 85,000, you're only going to get $1,250 rather than the full 2,500. And then it continues to phase out. So 86 would be 1,000. If your income AGI is 87, it'd be 750, and it would continually decrease until your AGI hit $90,000, at which point the entire credit is eliminated. Lifetime Learning Credit's similar. It provides a credit of up to $2,000 per eligible student. Again, qualified education expenses, tuition, any kind of books, things like that. Except for this one, there's no limit on the amount of years that the Lifetime Learning Credit can be claimed for each student. So higher education, for example, or if you're going back to school a few years later to get a different degree, things like that, and you've already used your AOTC, then you can always use the Lifetime Learning Credit. For 2020, it's again phased out if your AGI is between 59 and 69, and 118 to 138 if you file a joint. MAGI and AGI are basically going to be the same thing for most of you. There's some basically MAGI is modified adjusted gross income. AGI obviously is just adjusted gross income. The difference is just there's some add backs if you have some certain stipulations. I think a lot of it has to do with like offshore type of accounting. And with that, I'm going to rest my voice and hand it over to Mr. Hilario.
Yes, thank you, Jeremy. You did a great job covering the credits. Now, tax deductions, like Jeremy mentioned, they don't dollar for dollar decrease your tax liability. However, it does decrease your taxable income, which ultimately is where we apply the rates, or where the IRS applies the rates to get your tax liability. Now, with the credits, they're a little bit more, I guess, less involved, as far as you can go into your tax software and you can put in how old your kids are, or what the situation is, where a lot of the tax deductions, you're required to record keep or book keep, maintain receipts and things of that nature. So if we go on to the next one, we'll start with our first one, which is something that's directly related. Commissions paid. So this is a deduction that you can fully deduct, meaning there isn't any threshold on it. However much you pay out, and it's not commissions received, but commissions paid out, whether it be to another agent, etc. You can fully deduct it, and that fully reduces your taxable income by that amount. Now these add up pretty quick, so you want to make sure throughout the year that you're using some type of mechanism to track these. And I have an example here, which Jeremy, you are the point of view here. So Jeremy flips houses for homeowners who needs instant cash. He's working with another agent and decides he wants to pay them 5% on all those sales. So the other agent, they may end up making $300,000, which yields a $15,000 commission, which is fully deductible, and it goes on line 10 of your Schedule C. Now, Schedule C for sole proprietors and LLCs that do not elect to be an S Corp, they will have to file on their 1040 tax return a business return, which is called your Schedule C, and it's pretty much your income statement. So moving on to the next deduction, we have our standard auto deduction. Now I know you guys do a lot of driving around, going from one house to another, whether it's for showings or you're looking at houses for investment. There's two ways that you can deduct your auto expenses. One is called the direct expense method. Now with the direct expense method, what you'll want to do is track, your gas, anytime you go get an oil change, anytime you spend money on repair and maintenance for your car. Now, more times than not, that one is a bit more harder to track because you have to keep receipts and so forth. Whereas with the standard mileage rate for 2020, the IRS offers 57.5 cents per mile that you use for business purposes only. So we always suggest to our clients, once you get in the car, whether it's an app or QuickBooks or something of that nature, you can just click a button and start tracking your personal versus your business miles. It is asked and required that you report your total miles for the year, and then you bifurcate or split out what was for business use and what was for personal use. And more times than not, we often see that the 57.5% per mile always comes out to be more than direct expenses. And I don't know if that's just because people don't track their receipts as well, or, it's just, there's so many miles going in, and these cars are, if, like me, I have a Toyota Camry, it can go on and on low gas and a little bit of maintenance. So in this example, we have Marcus, who drove 4,000 miles last year for business, showing his houses and visiting homes for potential investments. We just apply that 4,000 times the 57.5 cents per mile, and Marcus takes a $2,300 reduction. And this goes also on Schedule C.
Kedron, a question about the auto. Is obviously want to be ethical, but let's just say I'm driving to a family vacation down in Gulf Shores and I visit the Keller Williams office down there, and maybe I taught a class as well. That's very much a little business thing that I did, but I also happen to be on vacation. Are those miles to and from Gulf Shores deductible if I do business while I'm down there?
So the way the rule is written is it's kind of subjective. So, it does say that you have to do a calculation to split, the business time that you spend versus the personal time and apply it. But, if ultimately your goal is, hey, I'm going to show this home and I'm spending this mileage to get to the home or teach this class and I got to get back home, then I would deduct the miles to and from. Jeremy, you have any comments on that?
Yeah, I would just say kind of the same thing. It's basically like, hey, you know what, if to get down there to teach a class, if you say, let's say you go down there to teach a class one day and you end up staying for a long weekend, the hotel and travel expenses related to this time that you were there in excess of your business time would not be deductible, but those that driving down, driving back, that would have occurred regardless of whether or not you took the extra days. And so those would be deductible.
Yeah. And again, it's pretty subjective. And I see Tabby loves subjective, those gray areas. All right, so our next one is legal and professional services. This includes lawyers, accountants, and any other professional consultants that you may hire. It must be an ordinary part of the business and necessary to the operations. So, if you hire a lawyer, just to look over documents, you can deduct that. If you hire a CPA for bookkeeping, to do your taxes, they'll have a tax prep fee, which will go on another line. But for any of the hours that they charge, for, let's say, putting in your PPP application or just reviewing something for you, those professional consultant items can be deducted on your taxes. So here you see Sam hires an accountant who's maintained his books at $500 a month. You multiply that by 12 for the whole year, and he deducts $6,000 from his gross income, which is a line item 17 on your Schedule C. So just more ways to reduce your income. And then you got advertising and marketing. And again, this is another subjective area or a very broad area, because there's so many things that you can do to advertise and market yourself. You can print things, you can buy shirts and allow your kids to wear them, or there's so many things that you could do to market yourself. So it's a very broad scenario, but this also goes on your Schedule C. So you'll want to be able to track those things. Anytime you maybe do an ad on Facebook, or whether it's printing your business cards or brochures. Here it says Jimmy spends $20,000 on staging, photography, brochures, open house, and his website updates for 2020. So with all this, he can deduct the whole $20,000 from line 8 on his Schedule C. So advertising and marketing, that's definitely, you want to track all your transactions, but making sure that you pick up advertising and marketing is going to get you a hefty deduction.
I just want to pitch in here and just say another thing that would go under this would be if you guys are hiring somebody, if you need an assistant or something like that, and you have to go on ZipRecruiter or any Indeed. We just did this, and we ended up spending around $1,000 just on the ads and the job postings to get that. And so it's again stuff that maybe doesn't seem that big at the time, but it all adds up.
Yes, sir. All right, so this one hits home literally, especially as most of us have probably transitioned more into a work from home work style. So when you're not out showing your homes and looking at investments and things of that nature, you probably will, spent most of 2020 working from a home office. So there's two ways you can deduct the use of your home office. There's the one simplified method, which tax softwares, they'll try to push you to do that one because it's simple. It doesn't require any type of documentation, no type of receipts. All you need to know is how much square footage is your office space. Now, for the actual expense method, it's a little bit more involved. What you'll have to do there is pick up all your utilities. If you own your home, mortgage interest. If you're renting your home, you have to pick up your rent for the year. And then for the utilities, we're talking water, gas, heating, electric. You can also apply any real estate taxes, your homeowner's insurance or renter's insurance. And what we do is we take a percentage of those costs, prorated or proportionately to your square footage of your office space to your house. So let's say your house is 100 or your house is 1,500 square feet, and you use 150 square feet for your home office space. then you'll take 10% of those costs and allocate it as a deduction on your Schedule C. So here in this example, Ashley, she uses a 2,000 square foot room in her 2,000 square foot home to operate her brokerage business. She opts out of the simplified method and uses the actual. So she applies 10% to all of those costs we list out. And then it's also required that you do an indirect versus direct expense. So like, let's say you buy furniture for that office space. Well, that's directly related to that office space, to your business. Now, water and electric, that stuff is going to be based on the 10% rule there, or the actual expense, so the prorated amount of your office use. Now, let's say you have a home office and it also has, there's a gym set up in one corner, a bed for, you to sleep in. The IRS actually wants you to measure out what you're just using for your business. If you're using the office for something else, they just want the portion related to the business. So you have to take a tape measure and split the room accordingly. But there's also a form 8829, which is a supporting form for the amount that goes on Schedule C, line 30. Then here's an interesting one that was changed this year, charitable contributions, which is limited to 50% of AGI. So charitable contributions, this includes, cash donations, non-cash donations made to nonprofit organizations. And then this year, what they did was they changed it up to say, hey, normally this is a part of your itemized deductions. And when we say itemized versus standard, itemized is if you are over your standard deduction threshold, which is $12,400 for singles, $24,800 for married filing jointly. I think it's $18,650 if you're head of household. If you're over that amount in itemized deductions, so going back to things like real estate taxes and mortgage interest, IRA contributions, there's a whole list of them. If you're over that amount, then you'll take the itemized deduction because it's more favorable for you. But if not, most of us, we're taking the standard deduction as a part of that Tax Cuts and Jobs Act, where it was increased nearly double the amount. So something new this year that they're doing is they're allowing a $300 deduction on top of the standard deduction. So rather than taking, if you're single, $12,400, if you make that cash donation, whether it's tithes and offerings for your church, or you bought gifts for a kid in need, you take that $300 and you just add it to your standard deduction, and that reduces your tax liability. So in this example, Edward has an AGI of $70,000 and he donates $300 to a local church. Although Edward is not itemizing, he's able to take the full $300, which is the threshold, the limit, as a charitable contribution. And where does this go on your return? Line 10 on Schedule A of 1040, which is the main form.
I just want to say one quick thing, because this is something that a lot of people get a little bit confused about. Even though you are making if you make a donation out of your business, it is still going to go on line. It's still going to go on line 10 of your Schedule A. It does not impact your Schedule C. So if you make a $1,500 donation from your business to, Kedron's kids cheerleader function or something, then you're not going to get that deduction on your Schedule C. It always flows to your Schedule A. So I just want to make sure everybody knows that, because it can be something where people say, well, I made this donation and I'm only getting, $3,000. I made it out of my company. Well, it's not really tax deductible because you're not itemizing except for that $300 that we're talking about here.
So here we have the self-employment tax. This is one that everyone, kind of gets blindsided by, you know, their first year of filing taxes as a business owner. We'll also talk about a deferral that we're allowed to do for 2020 to kind of help us with COVID-19 related situations. So here, any earnings over $400 or more, they're subject to self-employment tax. And this is a tax that's on top of your income tax. So if you receive the 1099 or you're self-employed and you receive, you know, business income, you have to pay a self-employment tax of 15 1/3%. Here, and I'm going to just highlight this example here where Mary, she's single and she's working as a realtor. And on top of the taxes that she has to pay, she owed an additional amount for the self-employment tax. She didn't see it coming, and she did not set enough money aside for it for the unexpected tax, which yielded penalties and interest. So for me, you know, as a W-2 and a self-employed taxpayer, you know, I know with my W-2s, you know, that there's going to be withholdings for taxes. I don't have to worry about that. Now, as a self-employed taxpayer, we have to understand that although we're getting paid periodically, you know, whether it's week to week, month to month, you know, we have to consider those taxes that we have to pay on the self-employment side. Where does this go on the return? Line 27 of Schedule 1. And then I got a question. Let's see, Mark has a question. There's a limit. Oh, it just went away. But there's a limit on self-employment taxes, just like ordinary income.
So to answer that, so self-employment tax or payroll tax is made of two components. And so there is Social Security tax, which makes up 12.4%.
Right.
And then there is Medicare tax, which makes up 2.9%. The Social Security tax phases out, or not, excuse me, doesn't phase out. It is eliminated in 2020 after I believe it's 137.5, and that got bumped to 142.550 in 2021. The 2.9% continues indefinitely. What part of Biden's new tax plan that he's trying to get involved is to have that 12.4% eliminate after, you know, the 142, but then pick back up after 400. So it's kind of like a little bit of a donut shaped tax plan. So you're taxed at 12.4 until you hit 142 or 145 or whatever it will be in 2022. And then nothing from that point until 400. And then from 400 on, it picks back up. This is one of the biggest reasons why people choose to or elect to file as an S Corp. As an S Corp, you set yourself a reasonable salary, something that's competitive. You basically say, how much would I have to pay somebody to do my job so that I could just sit back? Whether that's 60,000, 80,000, 120,000, whatever that number is, that's your salary. Your salary under an S Corp is the only thing that is subjected to self-employment tax. Beyond that, you're only subjected to ordinary income tax. So let's say that you made 150,000, or well, we'll say 140,000 because I don't want to do the math of the cap. But let's say you make 140,000, you set yourself up as an S Corp and with a salary of 60, that extra $80,000 above your salary is not subjected to 15.3%. So by doing that, you saved yourself around $12,000 just by electing to be an S Corp. Now you still have access to that money. You can still take draws from that money. It's just it's just a way to avoid those payroll taxes.
Yeah, and the S Corp election, actually the deadline to do it for 2021 would be, unless you do a late extension, this Monday, correct?
That's correct. It's 75 days after the beginning of the year. So to elect an S Corp status for 2021, the deadline, it's always going to be the 15th of March.
Yep. And then we're also offering, the IRS is also offering, because of the pandemic, income from March 27th through the end of the year, December 31st, 2020. You're able to defer some of that self-employment. You can elect to defer it or not.
Yep. And so it would be deferred over 2021 and 2022. You pay a portion of it in 2020, a portion of it in 2021, and a portion of it in 2022. So if you had a $12,000 liability, 4,000, 4,000, 4,000 is how it would take place.
Awesome.
Sorry, I'm trying to switch. Okay, there you go.
All right, so another good one, especially for the next couple years. I think there's a mistake on the slide, but deductible meals. So, you know, you're spending time building relationships with employees, contractors, vendors, and clients. So, you know, you may want to take them out for a nice lunch and show them some appreciation. Those meals in 2020 are 50% deductible. Now, if you do a meal that benefits the entire organization, so let's say you guys all get together and say, let's go out to lunch, that one is 100% deductible in 2020. Now, these meals, if you're just on your own, they have to be necessary meals through the ordinary course of business. So again, another subjective piece of it, because the IRS says, hey, if you're just going down and having a lunch at your desk, you know, technically that's not deductible. But then they also say it has to be necessary through the ordinary course of business, which, you know, in my opinion, meals are always necessary. So a little subjectivity there, but in 2021, and excuse the slide, but 2022, all meals from a restaurant are 100% deductible through the ordinary course of business, no matter if it's just you, you know, if it's necessary. And then, you know, if you're having lunch with one of those vendors or advisors, clients, or as an organization, this is a part of the Consolidated Appropriations Act of 2021. So for the 2020 example, this one here says Tim takes his client out to lunch and he spends $120. Tim, he can deduct 60% of of that meal on his tax return. And then in 2021, yeah, $60. And then in 2021, he can deduct the entire $120 if he had that same meal with the client. And this all goes on to Schedule C. And then next we have your tax preparation fees. Tax prep is always pretty complicated. So, you know, a lot of people, they'll go out to a tax preparer, whether it's H&R Block or TurboTax or someone that they know in the family, and then they'll just pay them a tax prep fee. It's just easier sometimes to outsource that tax prep than deduct it on your business return. So in the example, it says Lewis is an independent real estate agent and is charged $2,800 for his tax prep from a local CPA firm. He can take that $2,800 to his next return. So he would deduct it. If he did that in 2019, he can come into this 2020 return and deduct it from line 17 on his Schedule C. Next, your dues, subscriptions, educational, and training. You guys all want to keep track of those. I know there's a lot of classes that you may go to, or online virtual seminars that you may incur throughout the course of business. So make sure you're keeping track of those. It says Matt joined a business organization for real estate leaders. He pays an annual fee of $1,000. He takes it to his Schedule C. All right, next we wanted to cover, and I'm going to probably go 100 miles an hour now. I'm looking at the time, but next we'll cover the payment protection program and its requirements. So the first draw, it just required that, you know, you're a sole proprietor, independent contractor, or self-employed person. You could use your Schedule C income from 2019 to get 2.5 times your average monthly salary. What also outlined as a requirement is you had to be a small business that met the SBA standard. And then if you had a NAICS code with 72, which was foods, because they're focused in on trying to pick the restaurants back up, you could apply for even more money. So we're not for profit. So what'd you say, Jeremy?
Just you had to be in business on 2/15 of 2020 to be eligible. You could not,
yes,
which really hurts, you know, because we have clients who started on February 18th. She started on February 18th, and so she missed it by 3 days.
Ouch, ouch, ouch. And then, you know, next legislation, the second draw, PPP requirements. If you already got a PPP, you're automatically contacted by that lender for a second loan. The main thing is you would have to demonstrate a 25% reduction in gross receipts and comparable between comparable quarters. So it didn't have to be throughout the whole year. It's just you had to compare one 2019 quarter to a 2020 quarter and show a 25% reduction of that same quarter. So it had to be Q1 against Q1 or Q2 against Q2 and so on. What can it be used for? You can use this PPP for payroll costs, mortgage interest, rent, utilities, and worker protection costs related to COVID-19. Now, it's honed in mostly on the payroll cost, but and that's at 60%. So in order for it to be forgivable and you not have to pay it back, you have to put at least 60% of those funds into the payroll costs, and then the other 40 can be on the other 4 items you see listed here. Some considerations as of right now, and there's talks about extending the deadline. Applications are going to stop being accepted as of March 31st. So we only have roughly 3 weeks to take advantage of this, or until the funds run out. So, you know, either or, whichever one comes first. There's a limitation on Schedule C wages, so it's capped at $100,000 per individual. So if you have a salary of $100,000 or $200,000, they're going to just bring it back to $100,000. Or if you have employees that have $100,000 salary, that's going to be the cap over $100,000. They wouldn't be able to fund you that average monthly payroll, which if you're right at $100,000 or over, you're looking at receiving $20,833. There was an update where they're looking at gross income rather than net income. They were seeing a lot of businesses, they were struggling with their expenses throughout 2019. So they wanted to offer a little bit more money for those smaller businesses who weren't making a lot of money, not over $100,000, that didn't get capped anyway. So they started looking at gross income, which on your Schedule C is line 7 rather than line 31. And you'll apply at your local bank and business, you know, whatever you use your business checking accounts is most easy. There are independent lenders out there, but the process could be a little more strenuous and they could require a little more documentation. The main thing is that you keep good record for your forgiveness, so that way you don't have to pay this thing back. So your quarterly and annual tax forms, if you're paying employees, those would be your 940s, 941s, and 944. Maintain your tax returns, especially your Schedule C. Keep good transaction details, noting, you know, what's what, good categorization, and then copies of invoices. You know, of course, you'll keep the payroll register and how much you're drawing for yourself, but also if you're doing mortgage interest and utilities, keep those invoices.
All right, we're going to blast through some tax strategies. So the Tax Cuts and Jobs Act of 2017 introduced a significant bump in the standard deduction. So this is what we were talking about earlier. This is Kedron's favorite tax. I almost call it tax evasion because that's what it feels like, but it's not. So you won't go to jail. It's the best limitation on your taxable income. So basically, for single filers in 2021, the standard deduction is now $12,550. What that means is that you can pay your kids $12,550 each, and they will record their own tax return, and they will take the standard deduction and have no taxable income. And so what we tell our clients to do is have put your kids in some swag, print some shirts, have them be a modeling, a model or advertising, whatever you want to call it, for $1,000 a month, or whatever it is, $10.50 a month. Get to that $12,550, and then that's tax free to you, and they don't have to pay payroll taxes on it because they're under 18. So it's kind of a tax shelter for you if you have kids. Kedron's out here saving $50,000 in taxable income because he's paying each one of his kids $12K, and so it's a really good way to be able to avoid taxes. If you have, if you don't. There's other ways to do this. If you're not married, if you have like a partner, and they file head of household, and they don't work, that's another $18,000 you can pay to them because they get that $18,550 head household deduction. Trying to blast through this. All right. This is our capability statement. Basically, it tells you everything that we do. We provide bookkeeping, AR, AP, financial statements, bank recs, cleanup, transaction categorization, like we talk about all the time, tax planning, sales and use tax, business taxes, F&E, federal taxes, tax strategy and planning, kind of what we're doing right now. And then some advisory services, virtual CFO, cost cutting, budget to actual, any kind of decision-making analysis, operational support, things like that. Some frequently asked questions, temporary allowance for the 100% business meal deduction that begins and ends 1/1/21 through 12/31/22. So you got a 2-year span to get a full 100% deduction on that business meal. Let's see, expenses used to qualify for the PPP loan. Forgiveness deductible for income taxes. Yes, you may be granted for PPP loan forgiveness while still deducting those qualifying expenses. So basically with the PPP, originally they were saying, no, we're not going to count this. If you get this, you're not going to count it as income, but you're also not going to be able to deduct your expenses that you spent on this. So it's kind of like they kind of talked out of both sides of their mouth because it's basically recording it as income to begin with, because what you spend it on, you can't use for a deduction. Well, then in December, with the new I can't remember what the actual act was called, but that eliminated that. So now you both are not going to be counted. That money will not be counted as income, but also it is not going to, you are able to, gosh, I can't even talk. Not income, yes, expenses.
Remember, it was an Omnibus Act.
Yeah. So with the changes to the child tax credit, what do I do if I've already filed my 2020 return? Nothing. The increases for your 2021 tax return filed in 2022. Don't forget, you can get a draw off that beginning in July. All right, what do we got? 7 minutes for any questions. So
Fire them off.
Fire them up. Come on, we're not the only nerds here.
Did you guys see Randy's questions about political donations and whether that was included in the donation category?
I would have to look into that. I'm not sure if that political donation has been increased. I don't think that has an increase in the amount that you can deduct if you're taking the standard deduction, but I'll have to confirm that. I'll have to go look at the new publication.
Let me go into the chat and see if there's anything else.
I have a quick question.
Go ahead.
Can you explain kind of what the PPP is and just like what the purpose of it is, I guess?
Yeah, so the PPP is the Payment Protection Program, which was basically they're calling it a loan, but I'm going to say it's more of a grant that the CARES Act implemented, and the SBA is administering this loan. So it's to help small businesses because of the COVID-19 impacts that it's had. It's allowing those people that were impacted to take a loan out from the SBA. Some of the loans are as small as a couple $1,000s, and then some people are getting, several hundreds of thousands of dollars, and they're allowed to use it to keep their employees mainly, but also keep their business alive. Now, a lot of people are receiving this loan because, one, they need it, and then two, the requirements of it are it's so easy to be forgiven. All you have to do is fill out a forgiveness application, say that you spent it on the right stuff, and they say you don't owe it back. So that's why I say it's more of a grant.
Yeah. So just to piggyback off that, it's basically there to cover. You basically capture, average out your monthly payroll expenditures. With the second one, you can use 2020. With the first one, you have to use 2019, and you would get a loan in the amount of 2.5 months worth of those monthly expenditures. So if you spent $10,000 a month on payroll, then you would get $25,000 in a PPP loan. And so again, like Kevin said, there are different limit. There are levels of forgiveness application. So if it's under 150, it's only an attestation forgiveness application, which means you just click a button and say, I spent it all on payroll. Anything above 150 requires more documentation for the forgiveness.
Thank you.
Yeah, sure. Anybody else?
What was the name of that option where your kids are running around in t-shirts and they're filing their own tax?
Oh, that's
what I was thinking.
yeah. So it's not really a name. It's so basically you put your kids on payroll. You sign up for a payroll function. You put them on payroll, and you pay them $12,550 per year. That's what the standard deduction is. Now, what I will also say about that is that anything above that $12,550 is still going to be taxed at a much lower bracket than what you're going to be taxed at, because basically you're taking money off of the top tax bracket that you're going to be in, whether it's 24, 30, 36, whatever it is, depending on where you are, and shifting that money into a much lower tax bracket, because they're going to be in that basically that first $10,000 of taxable income. So that's going to be around 10%. And so you're not only are you saving on the first $12,550, you're also shifting that money over to anything above that is going to be shifted into a much lower tax bracket.
Now, do you have to put that in a separate account? Like they have to have their own checking
So
account?
yeah,
You have to show that
I always recommend,
that now for 2020, right?
Right. You can't do it for 2020. I always recommend, and honestly, I mean, at that point, it's kind of like, okay, I'm paying you, so you kind of pay for your own groceries and clothing, and you're funding your own
Vacations and things of that nature.
yeah, well, but your college education, I can't think of the whatever the numbers are. But all of that, they can do on their own. Now, what I will tell you is that you can still claim the child tax credit. It's $2,000, and it's a tax credit. Don't forget, only if they are not earning more than 50% of their support. So if you're paying $25,000 or more in groceries, clothes, daycare, blah 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 for them, then you can still claim the child tax credit. Once they eclipse that 50%, then you are no longer eligible for that child tax credit for them. One thing we didn't get to today too was depreciation on your vehicle. A lot of people like to put their vehicle in their business name so that they can take business depreciation on that, rather than just, so you get both, when the vehicle's in your name and your business name, you get all of your payments will be, well, the interest on all of your payments, because you're going to have a loan, but the interest on all of your payments are going to be deductible. You're going to be able to take depreciation, which vehicles have a 5-year useful life. So if you buy a $30,000 vehicle, you're going to get $6,000. Now, what I'll tell you is when you sell that vehicle, that all that depreciation is going to be recaptured as a taxable event, and you will be taxed on the gain. So a lot of people like to buy a vehicle, bonus depreciate it in the first year. So the first year that you buy a vehicle or equipment, you can bonus depreciate. Sorry, I have like 1 minute. You can depreciate the entire amount. And so if you buy a $30,000 vehicle and you say, you know what, I want to take all the depreciation this year, boom, you take all the depreciation. It's a $30,000 expense on your income taxes. But then 3 years later, you sell it for $21,000. Now you have a $21,000 taxable event that you have to pay taxes on. So just something to balance. But it's always nice to also you sell it and then you go buy another car. Well, boom, you can it's kind of flows, and it's kind of cyclical in nature.
And leases on cars, just for those who are leasing?
Yes, you can take the lease payments as an expense if it is in the business name.
Right to the Schedule C.
Yep. Anything else? Sorry, we went a little bit longer than we kind of expected to. Kevin put this thing together for us, and he really threw up a lot of slides.
I don't know about you, Sam, but I got a lot of information out of it, and I'm ordering t-shirts today.
Yeah, there you go. I got a guy.
It's really helpful.
Great. Well, I know. Yeah,
the future. So thank you guys for sharing that, right, around mills, because that's a constant conversation with our realtor friends, is around how you account for all the things we do out to eat.
Absolutely. Yep. And any kind of client lunch, anything like that. So it all counts. And I'm not sure if we have, I'm not sure if we have our contact information, but it's on, let's see if I can get to the slide. If anybody wants to contact us, up here is at the top right of that kind of capability statement, that's Kedron and my email address, and then also my phone number. That's my cell. You can text it, call it anytime, and we'd be happy to help you guys out with your taxes this year as well.
And I'll just say that doing your own taxes, I think it works fine for people that have like one W-2.
Right.
That's what I did for a long time on TurboTax. I plug in my one W-2, I take the standard deduction, boom, I'm done.
Yeah.
Once you have to start paying for the extra requirements for self-employed stuff on TurboTax or whatever, like it's really not that much more expensive to pay someone else to do it. And I just kind of liken it to, you guys know what, FSBOs, and they're probably leaving money on the table because they're selling their own house. And most likely, once you move beyond that W-2, you're probably going to leave some money on the table doing your own taxes, because there's a lot of things here that Jeremy and Kedron know about that we're just not going to be able to figure out. So I would encourage you, some of you probably already have relationships with accountants, but if you don't, talk to Jeremy and Kedron and get that taken care of.
Absolutely. We're happy to talk to anybody. All right.
Are we done,
Well, if we
Teddy?
don't have any other questions, I appreciate you guys having us here today. We really appreciate the opportunity to come over here and talk about